This is the Mobile Home Park Lawyer Podcast with Ferd Neiman. If you're looking to generate wealth and passive income in the lucrative world of mobile home parks, you're in the right place. You'll discover solutions to the common legal and operational pitfalls and how to optimize parks to maximize income. Your host is in the trenches. He's a real estate attorney, financial analyst, and mobile home park investor and operator. Now, let's turn it over to Ferd Neiman.
Welcome back, Mobile Home Park Nation. Ferd Neiman here again today with another episode of the Mobile Home Park Lawyer Podcast. Got another great guest for you today. He's an expert on all things banking, so really excited to learn from him some of his insights. I've done several deals with Keith. Please help me welcome Keith Asel with Hawthorn Bank. Keith, thanks for coming on, man.
Thanks, Ferd. Good to be here. I appreciate it.
Yeah, well, glad to have you. So I've known you for a number of years and done several deals together. Just knock on wood, so far they've all worked out. We've made all our payments. You haven't had to come after me, so that's worked out well for both of us. But for those who don't know you, maybe tell us your background and how you got into banking, and go from there.
Well, funny story about getting into banking. I used to mow the president's yard in Jeff City, Missouri, and he called me to come to work, and I threw the mower in the back of the car and headed up there and started to unload it. And he asked what I thought I was doing. I said, well, mowing the yard, of course. What did you want me to do? But started out being a teller back in 1980. So this is my 45th year in banking. Went through college working, teller jobs, customer service jobs. Got out, federal bank examiner for the Treasury Department for 5 years. Then commercial lending ever since. I did dealer floor plan, inventory loans, things like that, commercial real estate, pretty much kind of all things. Wore a lot of hats in banking, network administration, lending, compliance, facilities management, kind of wore all the hats there are, so to speak. And now I'm really just focused on commercial lending and kind of running the Kansas City and Springfield markets for Hawthorn. So been a great career. I like it. Got a few more years left in me too. So looking forward to those.
Well, good deal. Well, I know from talking to you in the past, one thing that makes you different, I feel like most bankers there's two types. There's either the credit guys that are trained to say no, or there's the sales guys that are always asking for the yes. I feel like you're the unique blend of both, because you got the bank examiner background where you look at the risk, you look at the credit, but you're also a man of the people. You're out in the community making deals, making loans. So maybe let's look at that bank examiner piece first. Like how does the bank examiner role impact your role at the bank today, and then just your lens for looking at loans?
In the bank examiner role, particularly where it comes around lending, it boils down to pretty much three things: cash flow, collateral support, and guarantor support. I worked on loans in New York when I worked up there, and they were 400 million and above. And at the end of the day, I had to write that loan summary up in one page, because it was really the same thing every time. Does the cash flow support the loan? Does the collateral support the loan if the cash flow is not there? And what strength does the guarantor add to it? It's really that simple. So you bring that forward into the sales role, if you will, and it's easy to, you can take that and visit with a potential borrower and say, okay, it doesn't really look like it's working here, but what if maybe you change the debt structure completely on an entity? And there may be some places to put longer term debt on longer payout and shorter term debt to where you try to get that cash flow to work. Because if it's not working for the bank, it's probably not working for the prospect. They're probably stretched liquidity wise. They're probably feeling the pain when they're making payroll or doing things like that, because maybe their equipment loans are on too short of an amortization. Maybe they put them on 4 years or 5 years when they should have been 8 years or 10 years for longer, heavier equipment. Various things like that. So that really plays into the ability to look at an applicant's overall debt structure, not just maybe a piece that's going to be with Hawthorn Bank, but maybe there's some with manufacturers, maybe there's some with seller carrybacks and things like that you can look at and go, rates too high, the amortization's too short, things like that, to really create more of a solution than just a one-off transaction.
Yeah, I know on a recent transaction we worked on, we had to look at combinations of, portions of construction loan, portions of, loan lines of credit for mobile homes, and then portions of interest only. So is that just essentially solving the riddle as far as how do we make this deal work so that it gives the borrower sufficient time to get the business plan implemented, but give the bank sufficient safety, so to speak, that it's a viable implementation plan?
Spot on. That's it. You're trying to come up with a plan that works for everybody. And for example, in a park, if you're going to go in and take a park, there's going to be a phase where you correct issues that maybe you see on the front end. That's going to take some time. Then you've got to, like you've taught me, go back in and put in, some of the things you need to fix it up and get it right. But then there's this lease up time too, where you're going to have to stabilize the lease before you can put it on the amortization. And during that period, you would typically expect to have interest only until you get that. Just like a multifamily project, they work and walk and talk pretty much the same. You're going to stabilize it, put in, maybe a new rent structure, new leases. And then at that point, whether it's, 12, 24, 36 months, then it's going to start amortizing. The thing with the banks is the longer you go out that interest period, the shorter probably the amortization. So if it's 25 years, but you're going to go 3 years interest only, they're probably going to want to see that P&I payment, the principal and interest payment on a 22-year basis or somewhere in there. But at the end of the day, on a park, it's land. So you're going to take that piece. I wouldn't suggest they should ever combine, the land with the homes. Those should be two separate loans, because one of the goals too is you're building equity. And if your lender is stretching out your loan too far, you're facing depreciation on homes versus building equity in those homes too. So there's this balancing act there as well on the home side.
Okay, that makes sense. So curious, you've been at Hawthorn for a long time, and its predecessor bank before that, I forgot the name of it. But other banks, are less, or sometimes I feel like are rigid. Can maybe give us some tips on how to work with the bank to get a loan that works? I mean, some banks say we only do 5-year term, 20-year amortization, 70% loan. Is that a bank that just isn't thinking as creatively, or is that just they're being more risky or risk averse, excuse me? And or how's pricing get involved? I mean, like, I don't get the same interest rate quote from every bank. Like, you guys are all essentially borrowing from the same source at the same rate. Is that right? But you guys are passing through different interest rates to the customer.
Well, start with the first question on underwriting, rigid versus maybe more flexible. It's been my experience, and without saying this is fact, that larger banks have got to build policies and structures that work for a larger employee base. If they've got 50 lenders, then it's going to be a little more rigid because they don't have time to look at each deal and say, well, this is a little different or that's a little different. They just say, here's the curbs, stay within them, and that's it. And lenders are taught, no, you can't go outside those curbs. And a lot of lenders get frustrated with that. Smaller, what I'll call community banks, where you don't have such a huge monolith of layers of management, they can get decisions that are more variable, if you will. They can say, well, maybe the first park we did looked like that, but this one looks a little different. So we're going to have to change a little bit. And we're going to have to go interest only longer. Or we're going to get an as complete appraisal versus an appraisal as is. And we can lend on the as completed appraisal because there's a bunch of improvements going in versus maybe a mature park that's you're just buying and it doesn't need anything. So flexibility tends to lend itself to that smaller to mid-sized bank. The key is with the really small banks, then you tend to get back into that. Do they have enough lending capacity to take care of you? The really small community banks may not have the capacity or the knowledge, because some lenders, one of the rules of banking is if you don't know what you're doing, don't do it. And so you may get into a situation where you're having to teach the banker, here's how this business model works. And fair enough, I mean, you had to teach me to a great degree as well how it works and get me comfortable with it. But I came from that inventory lending on the automotive side to where I sure understood the homes, but then you had to educate me on, if you buy a park, the improvements that have to go in, the cost of those improvements and timing and all that. So, but you can always educate a lender up, and usually you want to find a lender that's curious and wants to know and understand, because they'll be the ones who really work hard to create a solution that works for you and still fits within the bank's parameters of what they want to underwrite. As far as the bank's cost of funds, I'll call it, that can vary greatly. So banks that have a huge volume of just checking accounts, banks don't pay interest on checking accounts. They've got a lower cost of funds if that's a bigger percentage of their funding than banks who maybe are newer, that have to go out and borrow money to do that or pay higher interest rates on CDs and savings accounts to get new deposits in. So the banks make money based on the difference between what we pay on deposits and what we charge on loans. We call that the spread. And you kind of shoot for the old number was about a 4% spread between your cost of funds and what you made on loans. And you can equate that to what is that over like a US Treasury rate. So like right now, if I said you want a 5-year fixed rate, I'm going to look at 300 basis points or 3% over the 5-year Treasury. That's about 675 today. We'll call it 670. So banks with, and maybe more established banks are probably going to have a lower cost of funds than a newer bank, which is out having to try to buy money, if you will, from the population, quite frankly.
Okay, that makes sense. Now, I've seen over the years that I'm going to call it the index or the metric that we're basing this off of change. Like sometimes I see 5-year treasury, sometimes I'll see a 10-year, sometimes I'll see it's not LIBOR anymore, but other metrics. How does the bank determine those guys? It feels like it changes when it's not convenient for me sometimes. Maybe
You're very insightful.
yeah.
So,
It's like, wait a second. I saw in the news rates went down. How come my rate didn't go down? That kind of thing.
and that's a great question. So let's use the current example. Fed dropped the rates quarter. That affects the overnight rate, the short-term rate. But if you've watched rates, they've actually gone up on the 5, 10, 20, and 30-year securities that the Treasury is issuing. That is because there's this fear of inflation kicking in. But the Fed is trying to balance what appears to be increasing unemployment with, and increasing unemployment would say you need to lower rates to stimulate corporations to buy, basically buy employees, and versus their other mandate is keep inflation in check. And inflation right now seems to be coming up slightly. Some of that's associated with tariffs, but tariffs take 12 to 18 months to feed into the pricing. But you're not seeing a lot of it right now because profit margins are larger than they've ever been. So some of it is getting absorbed in the profit margins of corporations. We choose indexes, back to your question. It's hard to say why banks choose different indexes. Some use SOFR, some use Wall Street Journal Prime. Some use the Treasury yield curve, which we use most frequently if it's a fixed rate. It's all going to index off of something that achieves the end rate that they're looking for. So if Hawthorn Bank's looking to achieve a 7% rate on a 5-year fixed rate loan, we might look at that 5-year Treasury and go, it's 370 today. Okay, so I need to make 330 over the Treasury. And that's how I'll quote it. But if it's at 4, I'm going to quote it at 3 over. My goal is to get to 7%. And where they'll play in it is in that margin. And ultimately, it's a capitalistic society. You should shop your mortgage, your loan rates, and don't just get with one lender because you met them at the chamber and had a good lunch with them. Check with other lenders and get a term sheet. I always say get a term sheet.
Right.
A term sheet is a simple statement of here's what we would do. And it's usually not fully underwritten yet. They're basically going to take here's the parameters you gave me, and here is what the terms would look like, assuming we get your loan approved. And it's not uncommon for me to be one of 4 or 5 term sheets going on somebody's desk. So it'll also give you a feel for what's the banker going to be like going forward. I always say meet with them face to face. I would never do anything without meeting with your banker face to face. It's a character judgment, and they're looking at you for character. You want to look at them for it as well. And not that there's any bad actors in the banking world. I haven't met too many of those. Maybe as an examiner, 1 or 2, but certainly not since. But it needs to be somebody that is going to be a person you can pick up the phone and go, hey, Keith, we've got a problem with cash flow and liquidity. Can you sit down with me for 30 minutes and see what you see on this? Remember, we're analyzing your numbers every year we renew a loan. And so we've got a huge history of numbers, and we're finance people, not accounting people. So if your banker's not sitting down with you going, hey, here's the numbers, when you come to them and say, show me what your thoughts are, then you're paying them a rate of interest, a fee, if you will, for a service, not just the loan in my mind. And that means your banker should come out, sit down with you when you have questions and go through the math. We've got it. We analyze it every year. Why aren't we sharing that with our customers? We should be. It's and they should be sharing that with you and educating you on maybe here's something different I saw on a structure on a different loan that might work for you. We can't disclose who or what, but we can certainly say here's some insights we've seen. So you should work with a banker that's going to give you good insight and good feedback and good advice. Oftentimes I tell people, look, if the bank is saying no, they're seeing something that maybe you're not seeing. Take a look at what that is and let's figure out how to fix it. But banks are in the business of making loans. We make money by making loans. And if we have to say no, there's probably a reason. I've had several borrowers I've had to tell no, but I sat down and said, here's why no is the right answer right now. Here's how a path to make it, to fix it if that works for you. You've got, we can't tell you how to run your business, but we can certainly create a path to here's how we get to success.
Okay, that's good insight. So, yeah, and I'm familiar with a lot of this that, for other audience members as well. So I should get a term sheet, but that's just like, it's a preliminary term sheet. It's non-binding. I get that before I go into loan committee, which I'm not part of the loan committee. You are, you're taking it. I guess what percentage of the time would you say the term sheet changes materially based on loan committee? And then what percentage of time does it get rejected? I'm just trying to get a feel for, like, are you basically pre-rejecting me by saying I don't have a term sheet? And if you do give me one, it's like, that means you're going to fight for me at committee, and it's a matter, you may not have 5 votes out of 9, but you're at least going to be pitching it to the people that are in the voting members.
Great question. A lot of banks, like our bank, before we generate a term sheet, we go to a short, quick committee called term sheet committee. We try to keep it logical. And and the committee says, yeah, if it walks and talks like this, these are terms that are acceptable to us. Now, if we get into the full underwriting of it and something changes, then we would call you and say, okay, here's where there seems to be a change. We got new information. Maybe we can't get a clear lien to it, or the cash flow is not where we thought it was. But I'm not sure I've ever changed a term sheet, but I have heard of other banks that have changed them significantly. And to me, that's just not a very good business practice. And word gets out about a bank that's a bad actor, if you will, or a bank that isn't fully transparent and doesn't go into committee and fight for you. Generally, most of the banks I've seen, if they give you a term sheet, that's pretty much they're committing to those terms, subject to approval. So I don't see them change very often.
Okay, one issue that I had, not with your bank, but a different bank previously, and it just wasn't the way the structure of it was I got a 5-year loan on the land, and then I got permission for a line of credit for bringing in park-owned homes, but the line of credits, they renew once a year. So I made my business plan based on, okay, I get this line of credit. Well, then year 2, they said, hey, bank changed the policy. Instead of doing 100% line of credit, now we're doing 80% line of credit. Well, all of a sudden that means I need to put 20% down on dozens of homes. Well, I didn't have that money. This was a syndication, so I didn't have that money in the original syndication plan. So man, I couldn't get it from investors, so I had to put it up myself, or stop doing infill. So it was a unbudgeted cost. I have less leverage now, less debt, less interest, but I'm having to use my reserves to infill. Is there a way to mitigate that, or is there a reason some banks do 1 year on the line of credit when there's a 5-year on the real estate loan?
Yeah, a lot of times, and you're seeing banks drift a little bit longer out on those commitments because it's very expensive to renew loans. We've analyst times, lenders times, stock prep times. I would estimate it costs us about $1,200 just to redocument a loan. So given the times, I would suggest try to get a 2-year commitment out there. But banks do like to stick to 1 year because they want to look at it every year, especially if it's a newer relationship to a bank. You're not going to see those 3-year guidance lines out there until you've been with the bank for quite a while. Yeah, that's kind of odd for somebody to change up on you after the first year. I don't see that very often either, but you've obviously experienced that. So that's yeah. I asked the lender that. How often have you changed somebody after the 1-year renewal comes up? The renewal is really a matter of making sure we're reviewing credit quality every year, because we get examined based on making sure we know the risk in our loan portfolios. And one way we achieve that is annual renewals, to make sure that we don't get busy with something else and don't take a look at XYZ mobile home park and make sure it's going according to plan, especially one that's going through either startup or significant modification, because 1-year renewal means let's go back and make sure everything's getting done according to plan, that it still meets the appraisal, the way the appraisal was written, and then renew it. And then, second year, once it's stabilized, 2 or 3-year renewal on that. So
do you see banks very often try to like call a loan due during the 5-year term if payments are being made? I'm thinking, like, let's say my business plan is I'm going to bring in 10 homes a year for 5 years. So I'm gonna increase occupancy by 50 homes. I'm still making my payment, but what if I only bring in 5? Is that going to be a problem? Like, hey, you're off track, or is it just like they're just asking, hey, how do we get back on track? Or do they almost accept that long as payments being made, it's making some progress. It's just not going as fast. They accept that that's okay. How does the bank look at that?
Well, first of all, it's important to read your contract. I can't tell how many times I go to a loan
You've been listening to the Mobile Home Park Lawyer Podcast with Ferd Neiman. Ready to learn more? Go to www.themobilehomelawyer.com for free resources and materials to help you succeed. If you love the podcast, go to Apple Podcasts, give us your review, and subscribe today. Thank you for listening. Neither the Supreme Court of Missouri nor the Missouri Bar reviews nor approves certifying organizations or specialist designations. The choice of a lawyer is an important decision and should not be based solely upon advertisements.